All right. Hello, everyone, and thank you for joining us throughout the day here during the Lytham Partners Spring 2024 Investor Conference. Again, my name is Robert Blum, Managing Partner of Lytham Partners. During this upcoming panel discussion, we are joined by Erik Sloane. Erik is the VP of the Global Head of Corporate Listings for Cboe Global Markets, and Joe Lucosky. Joe is founding and managing partner of Lucosky Brookman LLP. And today I've asked Erik and Joe to join us to discuss the state of sort of the micro and small cap markets, in particular, how the major exchanges are adapting to today's market. So first off, Erik, Joe, thanks so much for the time today.
Thanks for having us.
Thank you for having us.
All right, great. Let's dive right in. Erik, let's start with you. For most people, likely unfamiliar with sort of Cboe and in the sense that I think we're going to be talking about it today, but maybe more from the option side of the equation. Help audiences understand the evolution and how you're competing in the global markets today.
Yeah, happy to. And I think you hit a key word there, Cboe. We're ourselves a public company. We're a 20 billion market cap global exchange operator, but I think our group best known for our capabilities in the option space. It's 50 years of history for us, and the inventor of the standardized electronic options contract, headquartered in Chicago. Lesser known about the business, the transition from CBOE to Cboe many years ago. We now are trusted market infrastructure providers in 27 different markets, options, derivatives, futures, FX markets, and the topic of our conversation today, trusted market provider in 6 different equities markets. US, our primary focal point of conversation, but we also own stock exchanges in Canada, in the UK, in Amsterdam, in Australia, and Japan, all through acquisition over the last 10 to 15 years. So giving everyone a bit of a view on capabilities, mission, vision for this organization, our goal is to be the trusted market operator in between investors, capital raising companies, asset managers, and the like, really be that single platform of choice and global partner of choice for aspiring public companies. This really the new focal point for us as a business.
Fantastic. Thanks for that overview, Joe. From your side of the equation, you're working with issuers, you're working with underwriters, you're working with investors. How does sort of Cboe fit into the landscape today?
Yeah, great question, Robert, and thank you again for having us. We really appreciate your time and the invitation. And hello, Erik. Great to always speak to you. I think having Cboe in the market was a welcome addition to the microcap for a number of reasons. As everybody knows, NASDAQ has been the 800-pound gorilla for many, many years, listing the most microcap transactions and generally doing a very, very good job. I mean, NASDAQ, because they have the most market share, they have the most scrutiny, the most eyeballs, and they have to change and adapt to the markets and different things that are going on in the world. So while they, everyone can do better and grow and progress, they've done a good job, in my view, of keeping our markets safe, helping our companies get listed, and moving the process along for all the entrepreneurs and emerging growth companies. And the same with the New York Stock Exchange, although they kind of have always done their own thing. Cboe coming into the market was a welcome change because anytime you have competition in the market, I think it's for the better. And Cboe has come into the market with a different approach, a more user-friendly approach, which is still playing out day by day, week by week, and a good approach to certain interpretations of the core 4 requirements for listing, which I know we're going to talk about in a little bit. So from my perspective, and I think from the general markets perspective, it's a welcome change, and we're really hopeful to see how this plays out over the next year or so with Cboe.
Joe, you joined us during our Investor Select conference back in, I think it was early February. And one of the things I took away from that discussion was really, you guys are data guys, right? I mean, you're data driven as a firm here. Talk about some of the, maybe the recent trends in the IPO trends, other financing trends, and what you sort of see as maybe the outlook for the markets going forward here. And again, we're talking small and microcap primarily.
Yeah, sure. This is my favorite question. Thank you, Robert, for asking this, because we are data guys. We get excited about data. As a law firm, we're committed to being great lawyers and advising clients, but that's just the beginning. At Lucosky Brookman, years ago, we really took the approach that data in the microcap is an important and valuable tool that can help our clients, help the industry, help the markets make better decisions, because the microcap data is not tracked. If you go to any website out there, sub 300 million is lumped into every other market, and it's hard to distinguish what is going on in the microcap. So years ago, in fact, during the pandemic, we started our Lucosky Brookman data desk, and we track every microcap IPO, uplist and cross list that comes out, and we do it quarterly, half yearly, yearly, and we dice and slice the data. We put some analyzation into it, we curate it, we put it out to the market for the betterment of the industry. But to answer your question, in 2021, it was the heyday, the recent, heyday, and anything could get done, any deal could get done. 2022 served as a stark reminder of the reality of the markets, and things had to come back to earth. 2023, though, surprisingly, was very strong in the IPO market, especially in the microcap, not because of dollars raised or average price or valuation, but because of number of deals. In 2021, there were 108 microcap deals that got done in the IPO side. In 2022, there were 71, again, a dip. In 2023, it went back up to about 87 deals. Even though the dollar amounts were less, and we're going to talk about why that is, a little bit later, the average valuations were down, the average prices were down, but the market is strong. Deals are getting done. Just instead of doing $15 to $20 million deals are getting done between $6 and $8 million, maybe a little bit less or more, depending on the deal. And that has caused the resurgence of certain issues and phenomena that we haven't seen back in 2020, 2021. For example, the resurgence of selling shareholders. In order to meet that $15 million float, in 2021, nobody wanted to talk to a selling shareholder because you could raise $15 million or close to that. In 2023, 2024, everyone's begging for selling shareholders to join the book in order to qualify. So that's been the trend from 21, the heyday, to 22, a reality check, to 23, back leveling off, at least as to the amount of deals, and dollars raised, valuations are still pretty depressed.
Erik, maybe following up on that a bit, sort of what you guys are seeing on your side of the equation, and maybe just sort of the I don't want to use the word the niche, but where your focus is in terms of the micro small cap space and sort of the competition in the marketplace here today.
We're in a pretty unique spot at the end of it. We're running stock exchanges on both sides of the border, Canada and the US. And then in addition, bolt in the conversations we're having in Europe and can now start having in Australia. And you start to get a really interesting macro picture of demand, what is there, what's moving, what's not moving around the world. And, echoing one point from Joe before elaborating on, other markets, economies, the US has continued to tick out micro and small cap deals, while other markets have been remarkably quiet. So demonstrating, I think, to some degree, investor demand and clearly companies still wishing to get out to public markets, and that trade being done both efficiently and meeting at a decent price point in market. If you extend your journey north, and Canada previously and will continue to be, I think, an exporter of good public companies into US markets as they grow and scale out of demand that can be met here in Canada. Ultimately, the US remains the bastion for everyone while they start looking around at where else can I raise money at good valuations. And your market's very clearly still open. A number of conversations we're having now around the world are great. I'm going to list with your exchange in local market, raise some capital, get myself sorted, organized, grow up a little bit. And then as soon as I'm ready, eligible, and prepared to thrive in the US markets, this is my second plan. I want to be dual listed into another country, access the world's deepest pool of liquidity in the United States. And that's my mission, my vision, my dream. I'd say, for most of our international markets, IPOs have been very slow. You look north, I think 1 or 2 have been out this year. But to Joe's point, we also have a lot of very strategic financing deals being done. It's family offices, strategic money, investors that are coming together to meet with a listing, but it's very targeted, very focused, and very industry thematic. And a lot of it's micro and small cap in those international markets that are driving south in due course.
Joe, coming back to, and you mentioned sort of the core 4 requirements, right? and sort of maybe they're hindering factors, maybe they're enabling factors, but talk about the core four as it relates to each of the exchanges and in particular sort of the, where, and Erik, I'll have you sort of follow up with Cboe in terms of how you differentiate yourself in the marketplace. So maybe Joe, why don't you go ahead and begin and help educate investors on those requirements for listing.
Sure. Well, when a company wants to get listed on an exchange, there's numerous quantitative and qualitative factors that have to be met. But there's four that really stand out. And we labeled these the core four a few years ago, and that sort of term has stuck in the industry. So once you achieve these core four, at least get closer to achieving these core four, usually the rest falls into place pretty nicely. So the core four, very simply, are shareholders' equity of about $5 million. You need a share price, generally, not including certain exceptions, of about $4. You need a public float of about $15 million, meaning fully public, non-affiliate float, freely trading shares. And you need, between 300 and 400 investors, depending on the exchange. So across the board, for NASDAQ, New York Stock Exchange, and Cboe, they're pretty similar. I mean, almost on their face, identical, with a few exceptions. But how they are interpreted from exchange to exchange at times can be radically different. And I know Erik will want to jump in here, but for example, let's just talk about shareholders' equity. This one is really, I think, gives people the most fits. The shareholders' equity and the public float are the two that really get a lot of energy and focus in deals. Shareholders' equity, you would think, is just the number from the balance sheet, shareholders' equity. Well, it is that way for Cboe and that way for New York Stock Exchange. It's not that way for NASDAQ. NASDAQ has a funky thing they call a burn rate calculation that they apply some formula to, looking back 18 months, taking into consideration certain, things on your income statement and applying a burn rate. So your $5 million of shareholders' equity may not really be $5 million. That's one of the big differences. There's other differences too, but really the core four is what everybody has to meet. And I know Erik probably has some thoughts on their more user-friendly approach, which again, I hope personally will evolve over time, and all the exchanges may come together and collaborate and make it a little bit, similar across platforms.
This is a key part, right? Like shareholders' equity, that $5 million number, ultimately, like it's a very clear and easy target today. The auditors, one of the core components of bringing a public company out to market, they go through 3 years of financial audits, they get them signed off. You get a shareholders' equity number on your balance sheet. And for us, and it's not just this way for the US, it's this way for our Canadian book, and it's how we're setting up all of our international markets. It's one number. Everybody knows where that bogey is, what they need to get to, what needs to show up on your balance sheet at time of listing in order to seek an approval. And that keeps it really simple and predictable ultimately for the working group, lawyers, bankers, the audit partners that are all trying to bring these deals coordinated to the finish line to list on an exchange. Hopefully it's with us. If it's not, great, the target simple. We treat that number the same way in Canada, and that's extremely important and simple as a standard for the companies to work for. And then Joe, on your note of being user-friendly.
Yeah, user-friendly. And I'll tell you this, the public float is another one that's really interesting and gives people fits. And I'll tell you, Cboe, at least for right now, has taken a refreshing approach to the calculation of public float, much like the New York Stock Exchange. Again, this isn't about NASDAQ. NASDAQ is the 800-pound gorilla. They've done the most listings. They have the most scrutiny. They have to, I think, act a certain way because most eyeballs are on them. I don't begrudge them at all. They have kept our market safe. They've done a great job, for the most part. But again, getting back to the public float requirement of $15 million, how do you interpret public float? Well, Cboe and the New York Stock Exchange do it a little bit differently, meaning there's a little bit more flexibility on what you count as public float. So for example, if you have shares that are subject to a leak out, NASDAQ won't count those as part of public float. So instead of getting the 15 million, if you have 2 million value worth of shares that are subject to a leak out, those don't count. Whereas on the New York Stock Exchange and Cboe, they may count or will count depending on certain criteria. And that's just another way of being slightly more user-friendly and reflecting the realities of the market and the realities of what float really means. So NASDAQ takes the most conservative approach. Cboe, New York Stock Exchange, take a little bit more flexible approach.
You know, and we're talking about sort of initial listings, but let's talk about continued listings, right? It's a topic many of my clients sit here and face on a daily basis. I was in at a conference here a couple of months ago where this topic was brought up. The $1 listing requirements, the continued listing. Sometimes it's 10 days, sometimes it's a 20-day continued listing. Erik, as it relates to Cboe and the continued listing aspect of it, any differences, similarities, any treatment that might be different as we're kind of talking about some nuances here?
And in the U.S. market, unfortunately, it's a lot like fighting City Hall for sub-dollar stock price discussions. I think for the most part, we all follow a fairly similar regime. You've got a 30-day window after the stock drops below $1. If it stays there, compliance notices start pushing out from our own exchange SRO that says ultimately we have rules. Your stock is below the $1 price minimum, and you've got 30 days to come back above $1, or you'll get a notice from us. And then after that notice, you've got time. It's usually 180 days as a matter of practice to come into compliance with the $1 closing price on our markets. Now, a number of different ways to address that. Obviously, if the stock trades back up again over the course of that window, you get to reset your timer and start that procedure again. But if it doesn't, then the traditional way and what has always been done and what's being rolled through in the micro and small cap space today is end up seeing consolidations in stock price, which require time, energy, effort, coordination. Unfortunately, that rule is a bit what it is, seemingly from our perspective, and certainly what I've seen with our peers in the U.S.
NYSE American doesn't seem to have that same requirement. Am I missing something there? Their requirement's slightly different. Is there a reason why they're put into a different bucket?
From my perspective, I wouldn't be able to comment on that. Unfortunately, Joe, maybe you've got
I'll tell you this. The reason why New York Stock Exchange is slightly different is because, remember, they list a lot less companies. So the market is pretty much 90 plus NASDAQ, the rest New York Stock Exchange, and now Cboe. So this issue comes up much less, at least in the micro cap on the New York Stock Exchange, because there's so far fewer listings. But let me just tell you about NASDAQ for a second. So the way the NASDAQ rule works is if you trade below $1 and you hit certain metrics, you generally get, if you apply for the first 180-day extension to correct that stock price. And Erik is right. If you can't do it organically through execution and communication, then you have to resort to a share consolidation or reverse split, as we call it here in the States. If you haven't done it by 180 days, and usually these things work in conjunction with another listing requirement. It's generally not just the stock price. Sometimes it's stock price and shareholders' equity. Sometimes it's stock price and something else. But usually stock price and shareholders' equity are the two that come up the most. So you need to get a 180-day extension, and then you have the ability to get a second 180-day extension. But NASDAQ over the last year or two has changed that guidance to say that the second extension is not really automatic. They used to be a little more liberal about how to apply for that second 180-day extension. Now, if you requalify, meaning you qualify for your initial listing standards on the other metrics, except for the one that you're out of compliance with, they generally will consider granting you 180 days. Otherwise, you have to go to a hearing panel. And I will just say, we do a lot of hearing panel work. I know there's some other consultants out there and generally do a good job who do this work. But as a law firm, we're one of the few law firms that do hearing panel representations. And I will just say, as a compliment to NASDAQ and their hearing panel members, I have found them to always be very fair and open and carefully consider the arguments for these emerging growth companies and for these entrepreneurs and for the shareholders. I have rarely found a hearing panel, or even within the staff of continued listings, somebody not willing to listen, not willing to allow companies to make a good faith argument. We've had an amazing track record with NASDAQ, getting companies that probably shouldn't have been given more leeway, getting them leeway to stay on the exchange and fulfill their dream and execute and build shareholder value. So it's very similar. I think Eric's right. You can't fight City Hall, and that part, the three exchanges seem to be aligned on.
All right. Yeah, Joe, one of the sort of trending topics here recently has been reverse splits with an uplist, right? Talk about what you've seen, some of what the data suggests, and the differences between kind of the exchanges out there.
Yeah, so this is a super hot topic. It's been this way for the last few years. So basically, in order to do an uplist, meaning you're listing from the OTC markets or cross-listing from a foreign platform to the New York Stock Exchange, NASDAQ, or Cboe, that's generally referred to as an uplist. And by the way, I'm not advocating for uplist. I think there's a lot of companies that, you know, time, right place, right growth, right money, that should potentially stay on their home platform, whether that's a cross-listing opportunity or even here on the OTC. Not every company at every moment has to run the NASDAQ, New York Stock Exchange, or Cboe. I think it has to be a well-thought-out plan. And one of the things we do is we do some listing analysis with our data, with all of our clients and our underwriters' clients, to try to find how that equilibrium, you know, can be achieved, and maybe not be perfect, but, you know, give them what we call within striking distance guidance to see how a listing would go. But a few years ago, NASDAQ, again, because they are the 800-pound gorilla, they changed one of their rules, which basically said that if you're going to do a reverse split greater than 50 to 1 or greater than 100 to 1, or really anything above 10 to 1, they may impose a 3 to 5 to 10-day trading period in between the reverse split and the listing on their exchange. And that has been disastrous for the market, because the whole point of listing and raising capital is to increase liquidity and to raise more capital. And they're basically imposing a risk window of 3 to 10 days. So you do the reverse split, you get your stock price to $4 or $5, and then you have to wait, sit on your hands, and pray that the stock price doesn't dip below. Because if it does, then you can't do the deal. You can't list without a minimum of $4. Again, saving certain exceptions and circumstances. So to me, that's worse for investors, worse for companies. The whole point is to increase liquidity on a senior exchange in theory, and now you're basing their metric to list on the lower platform or exchange. And it's been very, very tough for that market. And we can see in the data, there were dozens and dozens of uplists in 21. And when they changed that rule in 22 and 23, the market has all but evaporated. I mean, we're talking about single-digit uplists from the OTC and cross-list from foreign exchange because of this reverse split rule. And to Cboe's credit, and the New York Stock Exchange to some degree, they do it differently. And I think, Eric, you may want to sort of chime in here, because I know you guys take a more thoughtful approach to how to list these simultaneous reverse splits.
I think that the important part for us, you know, obviously we can look at it just in the home market, OTC up to our US exchange, like you would go to our peers. At the same time, we also run other international markets where, as I was sharing earlier, the conversation point is, okay, I'm going to list locally or regionally for now, but my eventual dream and ambition is to get to a US exchange, and hopefully it's with us at Cboe, and we create what we're now calling an intra listing between two different Cboe exchanges around the world. Well, that stock consolidation or reverse split is going to be a conversation point at some point in the future. And when you do that, you're interrupting the stock, right? You are reissuing identifiers, you're forcing a turnover of shareholders in the dealer back offices. These are all disruptions in your trading activity and your liquidity with your clients, while you're trying to affect quite possibly what can be a very big deal for your company, be that a capital raise, a transition, an entrance into the US markets, at probably the worst time possible when you're trying to create certainty and predictability and affect marketing and really drive success from an uplisting or an IPO into the US markets. So for us, you know, as Joe alluded to at the beginning, it's case by case. We're taking a look at each transaction that's going through, and we're trying to suss out size of a raise that may be coming into an uplisting, that may be justifying a consolidation. These are all the factors we want to take a look at alongside cap table, the rest of the deal, and valuation of the company, to get a sense of, is this a real price after it's being consolidated? Is there longevity here, or are we dealing with a situation where it might be a tight float company and it's going to be really hard to find a real price. And that's where we want to engage with each deal. We know every company, every deal, every transaction is different. And putting one massive blank rule across the entire industry is rather difficult to do for every scenario. So say this, the team's seen a number of these types of transactions. Some have stuck, some haven't. At the end of it, we're keen to keep learning from these, and from there, we'll provide guidance for companies as we find there's some standardization to follow. But for now, we want to take a look, we want to have a conversation, we want to engage. That's really where we are as a business.
You know, Erik, something you said here, and I listened to you at another conference out there, was sort of this intra-listing idea, and maybe just we have a couple of minutes left here, but is there a future where I'm not buying a stock on, the TSX, and then I'm buying it on the NYSE, or, I have to find where liquidity is at, and, whether international as well. Is there a future where you just go to one sort of exchange, one portal, and it grabs from wherever? Is that ever going to be possible given all the nuances of different countries and how they regulate securities?
It's the holy grail, right? Like
Right.
one central order book to run around the world. Reality, that holy grail could exist when you take kind of that quantum leap away from traditional equities rails, which is where all stock exchanges work today, with clearinghouses regionally and the dealers regionally. To get there, you're kind of into that blockchain ecosystem where you have one global central repository to work with and one view for all of your clients. Are we there now? No. Is it a future possibility? Absolutely. Today, what a intra-listing really means for us, and Joe's actually worked on a few southbound transactions from our Canadian business before to other markets. It means for us one global exchange, legal and listings regulatory team that's actually able to bring information intelligence, a same standard rule kit out to market, where a company can have a more efficient listing experience from the perspective of the exchange. There is no getting around rules and regulators. You still need to be an SEC reporting issuer if you want to come into the US. So you're going to have that experience working with us the same you would working with NYSE or with NASDAQ. But the exchange relationship, the due diligence we do on the company, your background checks on your officers, directors, management team, those are all things that we would have done in another region, which, if eligible, we'd be able to share that into our global team, which would then mean the experience working with our US markets. I mean, we know who you are already, and it can be more efficient for you and the management team entering US markets. The goal here is two-way flow, right? Number of companies that may need international investors. You look at a number of really good European companies now entering US markets. It's also about keeping access to the largest number of buyers you can find in the market. Joe likes to talk about data. There's no secret to public company stock price. You need more buyers than sellers, and your management teams have to deliver on results to create that kind of demand to drive a result, and they have to not dilute their shareholders by selling more shares into the market. So for us, finding and giving companies access to more buyers internationally, leveraging our markets around the world, absolutely our mission, and I think we're probably uniquely qualified to do it versus any of our peers on an international stage.
Fantastic. Joe, we're sort of kind of closing up here. Any sort of topics that we may have missed out on that you think are important for investors and executives that are watching this to understand?
Yeah, well, I just want to follow up on something that Erik said, which I think is a really, really good point, is that when management teams have to execute, we have these conversations every single day. They must execute. The money that they raise, this money they take from shareholders, it's not obviously for free. It's more than just economics. It's a trust. It's a desire for management to execute. And I think what happens is when we talk about companies falling out of compliance and our delisting conversation from earlier, management teams, everybody knows emerging growth companies have to raise more dollars. But when you raise more dollars and you fail to execute, and now you have a second round of financing to raise capital to execute on the first round of execution that you failed to execute. So you're on your second or third financing of dilution to still impact or implement your first round of execution. That's when problems occur. And maybe the answer is that companies don't rush to the higher exchanges. Maybe they have a more thought out plan on how they're going to execute and where they're going to use their dollars. The other thing I track and we track as data is professional fees in these deals. And I will tell you, I don't begrudge anybody making any money. I think everyone should get paid for what they do, but you need to have the right professionals in place and the right type of professional, not just to quarterback the process, get the deal done, and be proactive in challenging markets, but for the right price. I see some of these major law firms in the microcap, and there's nothing wrong with big law firms. I love big law firms. I'm a product of one. Most of our partners are products of big law firms. But when you have some of these ML 100 firms in the microcap, and their billing rates are astronomical, and the fees at the end are astronomical. Some companies are literally going public, getting through a SPAC deal, getting through a reverse merger just to pay professional fees. And that's crazy. I think as an industry, we have to come together and figure out this problem as well, because it's going to lead to what you said earlier, Robert, this vicious cycle of more dilution, lower stock price, more panel hearings, more delistings. And that can all be avoided, I think, with some thoughtful discussion among management teams and professionals. But I think the future of the microcap is bright. Number of deals are trending upwards. Deal prices are slowly ticking up. And as the broader markets get better and more robust, NASDAQ just hit a high already this morning as we were coming on live. That's all good for the market. And I think those dollars will start to come back into the market, and we'll reverse this sort of 18-month trend of, everybody running for cover.
Fantastic. Erik, sort of some final takeaways or closing comments on your side.
One big one, market conditions aside, I think investors are rewarding what is real. We're looking for fundamentals in businesses where, as Joe alluded to, executing on your plan and that quarterly report card companies, management teams, and their partners go through, very much under watch right now, and investors are looking at where they put their money. The right deals get done. Those that don't, unfortunately, they'll come back for another day. But I think that's the theme that we're hearing internationally now from each of our markets. If you've got the trust of your shareholder base to deliver, you've got them, but you've got to show results. Fantastic.
Erik, Joe, thank you very much for your time today. Greatly appreciate it. Maybe just for anyone that would like to get in touch with you, what might be the best way? Joe, I'll start with you.
I mean, I think most people know where to find us, but obviously our website, lucbro.com, lucbro.com, or really on LinkedIn. We really try to be active on LinkedIn and let the industry know what's going on, more than just deals, more than just any one company, but really as an industry as a whole. I mean, we view our role at Lucosky Brookman as more than just deal counsel. We want to do the right deals with the right people, but more importantly, we want to educate the community. We want to uplift the ecosystem. We want all exchanges, all participants, all professionals to be safe and grow and make this the most vibrant community in the financial markets. So LinkedIn's a great way as well.
Fantastic. And Erik?
Same here. LinkedIn's nice and easy, and we'll quickly get you out of LinkedIn messaging into an inbox and onto the phone with any part of our global team, US or otherwise, that you may wish to chat with.
Fantastic. Well, guys, thank you so much. Greatly appreciate it. We hope you enjoy the rest of the conference, and sure we'll be talking again soon.
Thank you, Robert.
Thanks, guys.